This is not the first time NSE is rolling out a new product. If you remember the real estate investment trusts, which unfortunately were a flop in terms of market appetite, which suggested the NSE had not invested enough time to prepare the market for this kind of product. Do you feel, from an investment banker's point of view, that we are adequately prepared for derivatives?
I think so. As is mentioned, they've done a lot of education, investor education, and the key market is the fund managers, and they're aware of the product and they're actually looking forward to it. We had 2 phases where they carried out a test, and a number of us investment banks participated, and actually AIB came up top in the 2 trials, and we've interacted with the clients. We've told them this, just basically educating them and giving them, making sure the appetite is there, and so we're hopeful that when it starts, and I think the most important thing is that they're aware of what the benefits it holds, and so the hedging, especially for portfolio managers, and some people who are interested in speculation would also participate. So we are hopeful it will be.
Okay. And it sounds to me like this is a product which unfortunately is being tailored for what you call institutional investors, that is fund managers and pension funds, etc. Where are we leaving retail investors in this, Sarah?
Retailers can also participate, the size of the contract. So one of the advantages of buying a derivative as opposed to buying a share directly is lower cost. So if you were to buy, like suppose Safaricom share, the trading cost would be around 2%. For derivatives, it's around 0.1%, which is lower, and then also the contract sizes are pocket friendly. But in terms of, the reason why I mentioned institutional clients is because of the volumes. So like REITs you mentioned before was not very successful. Retailers participated, but institutional clients did not participate. So institutions tend to have the volumes which we need to make the product successful. So retail clients can still participate, but the institutionals are the ones who bring the volumes.
Okay. And across the world where we have seen derivatives emerge, one of the key challenges has been the underlying risk which they present, because some entities would end up taking up too much risk because, of course, derivatives now enable you to caution yourself. Do you feel we're sufficiently prepared from a regulatory standpoint? We know CMA has been undertaking a number of reforms just to prepare us for this, but do you feel we are ready for this?
I think we're ready for this since, one, we are governed by the Capital Markets Act and the Capital Markets Derivative Regulations. And on top of that, we do have the NSE derivative rules, which are public to everyone, and everyone can see what it entails from them from a regulatory point of view. Then additionally, to your point regarding positions, in every product and every contract that we have structured, we do have what are known as position limits. So no single client or no single broker, for that matter, who is supposed to execute your trade, is not required to hold to exceed a certain percentage of the total outstanding contracts in the market. And the key point for this is just to ensure that there is no cornering of the market, and no one entity or no one client holds the market ransom, for that matter.
I see. Let's talk about the contract sizes and how they're structured and how this is because the key issue we normally have here is we normally discuss this issue of we have a lot of institutional investors and very little retail investors. Tell us about the contract sizes for the derivatives market.
So the contract size is threefold, if you can mention that. So there's a contract size for the equity index. So one contract of the equity index will represent 100 points, of the said index. So if that index is worth, as we've mentioned, let's say the NSE 25 index is trading at 3,600 points for today. So one full contract, notional size, what your exposure will be 3,600 multiplied by 100. So 360,000.
Yes.
However, what you need to pay, and as Sarah was saying here, you just need to pay a fraction of that amount in initial margin and hence participate in that contract. And the initial margin rates vary between anywhere between 5% and 15%, depending on the volatility of that underlying security. And then based off of that and apply that to the notional amount of contract is the amount now you need to pay in actual fees and in actual margin for you to actually buy that contract. So assuming a flat rate of, let's say, 10%, so 10% of 360 60,000 gives you 36,000 to buy one index contract, and that index contract gives you exposure to 25.
Rufus, you did mention that one of the incentives is that unlike the spot market where I have to pay up upfront before I begin trading in the stock exchange, now here I only pay a margin. And a contrary view to this, or skeptics would say that part of the reason why you pay upfront in the spot market is that you are able to put your skin in the game or to invest where your analysis is based. But now in the derivatives market, if I'm only putting 10% of what is required, then the appetite for more risk is likely to increase, right? And this presents a risk for the market.
I'd say there, to your point, risk will definitely be amplified in terms of leverage, since that is leverage.
Absolutely.
But there is different investors come to the market to satisfy different needs, okay? So if you're coming to the spot market, the share market, for example, you want to own the underlying stock. You want to get the capital gains if Safaricom moves from 27 to whatever amount it can move to. And you also want to partake in dividends, right? What the derivatives market offers is what we call an efficient way to deploy capital, okay? So a fraction of that gives you that exposure, and then you can also use that to manage your risk. So you can see those two investors are coming onto the market to do very different things. One is coming to get actual ownership of the shares, and while the other counterparty is coming there to effectively manage their risk and deploy their capital more efficiently.
Let's look at the two main players we have in any derivative market. We have those who are coming to hedge their risk and those who are coming to speculate, those who have high appetite for risk, if I could say.
Yeah.
How do we ensure at the Nairobi Securities Exchange level that we don't have a market skew where we have a lot of speculators but very few people coming to hedge? Because that is a common problem afflicting a number of derivatives market across emerging economies.
Okay, so in terms of the different category of players, you'd appreciate standing even from the exchange's side. You really know what each individual player is coming to achieve when they're coming onto market. Some might be hedgers, some might be speculators. So from our end, what we've just tried to minimize, and I'd mentioned this before, in terms of position limits, in terms of client limits, just make sure each client does not hold too much of holding such that they skew the market or corner the market.